I want to, link back your vision for Bank of America, which really has been driven by a strategy of low risk, high reward, and link that to what we're seeing happen in India. There is a debt issue and a debt problem when it comes to corporate India. Balance sheets continue to be stretched. There is a leverage issue which has constrained some of the aspirations, and there are governance issues as well. How are you looking at this mix today in India?
Well, I think a couple things. Number one, in emerging economies, it is not atypical to have an issue that you need to borrow more money than you have in equity and financing, and that's just sort of the imbalance. So I think the key is to have open capital markets, to keep pushing the capital markets so more and more money can come to this country to provide the equity financing and help deleverage and help drive it. The second thing is, I think, you have to be careful about the public sector banking system, and I said that last year, and it may not be the most popular point, but I think the idea is the private sector and the change of the bankruptcy code and things, private sector from the banking and also the change in the court system, you have to have a movement of people who are successful, that's part of what capitalism has, and as you move those through, it's painful for the individual firm, but the fresh start of bankruptcy and the moving the bad assets off through the banking system quickly, both are good things, because sort of limping something along on lifelines is not a good thing. And so the code has changed, and that's going along. So I think that's a structural change that has to keep taking place. But it's difficult, because if you need the development loans and you really want to push SMEs and things, I can understand that. But the private sector tends to win or lose, and when they do, that then meanders the economies towards the better place, and so you see that in the U.S. But I think that those are the things they have to work on. But those are growing pains, and in the sense that this is a huge place that is growing very fast on a relative basis. So of course you're going to have debt excesses and things like that. But I think that the idea is the people make mistakes have to go through the capital system, come out the other side. The people ought to be rewarded and keep growing, and that's what will happen if you have open, sort of restructuring and things like that.
And we've tried to put that process in place with the IBC code, but specifically on the issue that you brought up on the government holding of public sector banks. And this, perhaps, to a lot of people has been the one big disappointment with the reforms agenda, because the assumption was that we would, in fact, if not see privatization, we would at least see a significant reduction as far as government holding is concerned to improve accountability and bring in efficiency and all of those things. Is this a big structural reform that you continue to believe you might see positive movement on, or have you given up on this?
Oh, I think it'll happen over time. The question of pace will be the government's decision at time, but it has to happen over time, because at the end of the day, private access to capital, private ownership, the discipline of private ownership, the world coming to that private ownership and investors and discipline we have, and the regulatory scheme around that. So I think that's just positive upside for the country over time. But you can't do what I do, which is run one of the largest banks in the world in the private sector and provide great services to clients and great discipline and risk, and not think that that is the right structure, because it is. We are able to take we invest $3 billion a year in technology, pure code, not operations, not the backbone, but just pure ones and zeros, new code every year, to provide better products and services to our people and our customers, our clients, our teammates. And that kind of innovation is hard to do unless you have that private sector demand that you do it, and both from the customer side and the investor side.
Since you're talking about your strategy, which has clearly paid off, and that's evident in your numbers, one part of it is this business of driving innovation and improving the quality of the product and services and reaching out to more customers. The other has been your strategy on expense control, and you've been able to shave off about $4.3 billion in savings in the last few years. But how hard was it to move from a culture of taking the big bets, taking the high risks, to a sort of more back to basics approach?
Well, there are two questions about that. One was a lot of what happened in our company through the 2000s were acquisition bets. It's illegal for us in the U.S. to make an acquisition. It has been because of the amount of deposits we have. So the banking industry in the U.S. is very disaggregated, despite what people say. We have about 14% of deposits, so we're above 10%, so we can't make acquisitions. So my career, and my team's career more importantly, is defined by organic activity. And so the big bets around acquisition, the big restructuring. when you think about operationally, we do loans that no one else in the world can do. We do technology deployments no one else in the world can do. We are very aggressive where we know the risk and drive it. In the markets every day, we have a $600 billion balance sheet providing capital and transition capital for all the investors in the world. So it's not that we don't take a lot of risk, but it's we take it within the context of organic activity, not inorganic activity. That has allowed me to have the team to have the company really focus and grind out that. The expense side was really due to just needing to get the company on a sound basis, and the team's done a wonderful job. And so from when I became CEO 10 years ago, when the management team took over to now, we're actually down $30 billion per year in operating expenses. It were different stages at different times, and in the last 3 years, we've taken out $4 billion, as you've said, per year. But we've done that by investing in technology, investing in efficiency, and driving operational excellence.
We had this conversation when we last spoke as well on the disruption that technology is bringing about as far as the financial services business is concerned. What does it do to bank branches? What does it do to the manner in which customers transact with their banks? What do you see now over the next 5 years? I mean, we've seen a lot that's already changed, but what is the future looking like now over the next few years, especially driven by technology?
Well, to me, there's 4 or 5 major trends that play into this question. And then there's the clients and customers that play into this question, because at the end of the day, you don't build technology for technology's sake. You build it for your clients and customers, and by the way, for teammates to enable them. So what are the 4 or 5 big things? Voice recognition has changed the game. Artificial intelligence, machine learning, and those derivatives. The ability to store major amounts of data and access it and deliver it. And then networks. What people don't realize is that none of this works without a network. So we have in our mobile banking, we have a thing called Erica. Erica is a voice-activated artificial intelligence personal assistant that operates today. 5 million people plus use it today. This is not something theoretical. 5 million people are using it, active users of it. That requires a new natural language, because financial services is different from other things that you might talk to.
I want to go back to a question that we were discussing, and that was in the context of elections in India, but I want to talk about the US now. And this discourse of what we saw post the financial crisis of too big to fail, especially for the banking sector. Now Elizabeth Warren seems to be stirring up a pot when she talks about too big for good in the context of large technology companies. Do you see this becoming a big election issue?
I don't know. I mean, you'll see people play out. But I think let's back up. I'm work with the International Business Council out of Davos and WEF, and I think if you really back up a lot about it, companies are now trying to do what we call the genius of the and. Be very profitable and do what they need to do to drive their business and do good for society. And you have to do both expertly. It's not that you blend them together and do them both average. And I think that's where the corporate world is really focused on. And so the profits and the clients and the customers and what they're trying to do, the and is really UN sustainability goals. And so a lot of us have dedicated more and more, and that's the ESG work, and it's all the different work. There's many different facets of this. But a lot of us have committed to and developed, and so last year alone, we put about $50 billion against the SDGs. And I think in the end of the day, the world has spoken and said we want to make the progress embedded in the SDGs, and so if you think about what would you like the power to do, if you ask the world, they would say we would like the power to have timely progress on the SDGs. And if you think about corporate world's trying to achieve that, and there's no debate. I think there are factions out in the world that think that corporations don't do this, but they have to do it, because at the end of the day, there is enough charity, there's enough government spending. The private sector has to solve these big problems, and capitalism will help do that and bring trillions and trillions and trillions of dollars as opposed to billions of dollars.
The mood since January and continues post-Davos has been one of cautious optimism, of nervousness. What would you be most concerned and nervous about today?
So I think the economies around the world are predicted to grow at a less rate in 19 than they did at 18. And they're predicted to grow a little less rate even at 20 than 19. So the concern is whether they've got that right. That is a tip over and a flattening into strong fundamental economies with good demand, as opposed to a trend that's going to keep going down. And we don't see anything. We think it's basically a less fast growth as opposed to a recession or anything like that. The key to that in the U.S., the key to that in Europe is going to be what people do. Do they spend? Do they live their lives? Do they provide final demand for products and services? In the U.S., we see final demand by consumers still strong. Not as strong as it was last year, but as strong as it was 2 or 3 years ago, which people felt pretty good. And so, but why isn't it as strong as last year? Because you had a lot of stimulus, a lot of tax, all this stuff went on. People are employed. Unemployment rate's as low as it's ever been. I mean, like new claims for unemployment, yes, are back to where they're in the 60s.
Yeah.
You know, in sheer raw numbers when half the people worked. So it's twice the working population in the same nominal number. Think about the dynamics of that.
Well, we wish you the very best of luck as you continue to marry profits with progress. Thanks very much for your time. Appreciate you joining us here on CNBC TV 18, and all the best for your trip here in India.
Thank you very much. It was wonderful being here again.
Well, with that, it is time for us to wrap up the CNBC TV 18 special. From all of us here, for now, goodbye, and many thanks for watching.